Good morning. Welcome to the Five with Fitz. I'm Keith Fitz-Gerald. Thanks as always for being here. So, core PCE came in at 3.3% this morning, right in line with what the street was expecting. Headline inflation, of course, at 3.8%. GDP for Q1 revised down to 1.6%. Why they can't do this stuff in real time in today's day and age, I don't know, but let's just leave it at that. Anyway, all three averages are in the green as I type, but to be fair, I'm still leery of a holiday shortened downside spurt. Maybe they split, Dow might go red, the other two might stay green. I don't know. So I want you to focus today. That's the important part. That's what I'm doing. And the reason I'm doing that is because volatility, which everybody usually associates with a downside move, volatility actually cuts both ways. So it's important you have a game plan and you stick to it, especially at times like the present. So here's my playbook. Number one, I have been looking forward to this day for 2 years. Let me explain. Time is a funny thing, and not many people remember January 9th, 2007, but I do, and vividly. That was the day that the late Steve Jobs walked on a stage in San Francisco and said simply, quote, "This is a day I've been looking forward to for 2.5 years." Then, for the next few minutes, Jobs took a stroll down memory lane at Apple, talked about iPhones, talked about phones, and he talked about the current limitations of technology in place at the time. He dropped hint after hint about a revolutionary product and moments later, quite literally, dropped the game-changing new iPhone out of his jean pocket. Everybody gasped. Now, I can totally identify because today, most investors are using a roadmap that was designed 30, 40, even 50 years ago to navigate a world that looks nothing like it did then. And as a result, many are missing opportunity because they're spreading their money around thousands of stocks, hoping to stumble into a few big winners that actually move the needle, but rarely, if ever, do. Now, my new to ETF, the Fitz-Gerald must-have portfolio, the NYSE Arca FITZ, exists because I believe investors deserve better. The premise is very simple. Ask yourself, what if you could own 20 to 30 of the world's best, most successful companies making must-have products and services the world can't live without, and in doing so, align your money with huge structural changes that are based on where the world's going rather than where it's been, all in a single, easy-to-buy, easy-to-understand exchange-traded fund? Well, that's the premise behind Fitz. So there's a video in the written version of the Five with Fitz, which of course takes you back to the video version of this, that I want you to watch if that's of interest. And if you decide that's of interest and it meets with your risk tolerance, your objectives, and your circumstances, which I don't know, I'd be honored if you'd consider investing. Do me a favor, read all the legal stuff you got to read and listen to this because I've got to say it. Investors should consider the investment objectives, risk, charges, and expenses carefully before investing. For a prospectus or a summary prospectus with this and other information about the fund, I want you to visit the link that's in the written version of the Five with Fitz. Take a good hard look, read the prospectus or summary prospectus carefully before investing because all investing involves risk. Principal loss is absolutely possible. Fitz is distributed by Foresight Fund Services, LLC. Phew, done. Anyway, number 2 today. Dividend investors, beware of $1,000 car payments. I mean, oh boy, brain explode time. Like you and I haven't seen this coming from a mile away. Experian Automotive analyzed more than 5 million open auto loans and leases during Q1 and found that nearly 19% of new vehicle loans include a monthly payment of at least $1,000. I mean, seriously, folks? Most assume that this is high pinky stuff, luxury vehicles, but it's not true. CNBC is reporting that 74% of the loans in the $1,000 plus monthly payment club are non-luxury vehicles. In fact, the top 5 are all pickup trucks, including the Ford F-150, Chevy Silverado 1500, and the Ram 1500. Just 5 years ago, $1,000 plus payments accounted for a mere 5.4% of the market. So, here's the challenge, my friends. Traditional car makers bank around 5% of their revenue from loans, but between 15% of the profits from those things. That number has run as high as 50% when vehicle sales get soft, which means that rising delinquencies associated with these expensive piston clankers aren't just a consumer credit story. They hit Ford Credit and GM Financial directly, and those units are quietly what fund the dividend, the buybacks, as well as EV and AI ambitions. Now, Ford really learned this, or nearly learned this, the hard way in 2008. The loans are bigger now. The terms are longer now. And a $70,000 truck depreciates a whole lot faster than the folks who finance those things seem to realize. I mean, yeah. Anyway, trade idea, put skis on the conventional automakers are simply short, avoid, and find better choices. Not to mention cars that people actually want to buy and profits that come from a much broader construct. You know what to do, and chances are you know what to buy too. Anyway, Keith's investing tip: if you understand one thing about any stock you own in any industry, understand this. Does it make a must-have product or service? And is the business unit that does that the company's most important, profitable, most innovative profit center or business unit? If not, you got some reconsidering to do. Anyway, number 3, Snowflake. Time to buy? Well, Snowflake jumped 36% last night and is trading at around $235 or so as I record this. That's not too shabby. Big jump. Revenue came in at $1.39 billion, up 33% on the year over year, beating Wall Street's estimate by about 5% if my memory's right. Adjusted earnings of 39 cents crushed 32-cent consensus by nearly 22%. Revenue, of course, hit $1.33 billion, up 34%, the strongest sequential dollar growth in the company's history. Guidance raised, margins improved. I mean, by any measure, this is a clean beat. But the real story, in my humble opinion, is the AWS deal. Snowflake committed. Boy, I've rented lips today. It's been a busy morning. Committed to spending $6 billion on Amazon Web Services over the next 5 years, including Amazon's custom Graviton chips and cloud-based GPUs built specifically for AI workloads. Now, to put that in perspective, right, when Snowflake went public in 2020, the equivalent commitment was $1.2 billion. By 2023, it had grown to $2.5 billion. Now it's $6 billion. I mean, this is fabulous stuff. But, and as always the case, there's fine print. Because, there's always some fine print. GAAP operating loss was still negative $326 million this quarter, and what catches my attention is that shareholders' equity is down nearly 20% year over year. Stock-based compensation, of course, continues to dilute existing shareholders. Insiders sold heavily at 175 to 106. So what is it, 175, 176 in the days before this earnings report printed, which of course catches my attention. If these were planned sales, fine, not a big deal, but I have not had time to check that. If they were unplanned, then that's a warning flag. So we'll have to take a look. And by the way, tip of the old hat to everybody who owns Snowflake. Well done. Do stay frosty though. Trade idea, personally, I'd love to short Snow or buy puts and bet the stock declines, but the markets may not give me that opportunity, so we'll see. All right, number 4 today, gold had one job this year and it blew it, or at least is blowing it. People have argued with me for years. Gold is the bomb, they say, and the list of reasons why they give or gave is always the case, and it's as long as my arm. War is going to break out. Oil is going to spike. The Strait of Hormuz is shut down. Inflation is back. The U.S. dollar is complicated. My response is the same. Don't bet on it. In fact, I've told you it's far more likely to go the other direction repeatedly, especially this year. I still think that's the case. Yeah, gold's had a run up. Don't get me wrong, 50% year over year, if my memory's correct, and if you're keeping score. But the peak was the tell here recently. So far, it's down something like $920 and about 16% from the top of, what is that, $5,595, which means that loads of folks who thought they were being smart are already getting left high and dry. So my 2 cents on gold is that you tread very, very carefully if you own it. The trade may not play out like you think if you're one of millions betting on gold going to the moon, so to speak. ETF outflows in March were steep. The WGC data shows a big reversal from Q1 2025, and higher for longer rates are frankly killing the non-yielding bid and institutional world. So history suggests a fall of 20 to 40% wouldn't be out of line from current levels. Keith's investing tip: gold these days has nothing to do whatsoever with the macro story anymore like it used to. It's all about whether the institutions are buying or selling. Simple as that. And number five, I've rented lips again, because I've rented them again. It's repetitiously redundant. But anyway, did Mondami seal New York's fate? Just ask Seattle. Well, New York just passed, what is it, pied de terre, I can't pronounce that. Anyway, on non-primary residences is taxed to help close the city's budget gap. He and his colleagues might want to take a look at what's happening in Seattle, where property values are already dropping as new taxes create sticker shock for lots of people. Now, history shows very clearly that it doesn't tend to end well when politicians decide the rich, however you define that term, I don't care, I don't do politics, I do money. Whenever they decide the rich, however you define it, have too much money and the government needs more of it. In case you're not familiar with what's happening, Washington Governor Bob Ferguson signed what's called SB 6346 into law in March, a 9.9% income tax on households earning more than $1 million annually. Now, the tax doesn't even kick in until January 1, 2028, with the first payments due in January 29, if that's correct. But, if my memory is correct, the damage is already happening. That's the key here. Active listings in Washington State surged, real estate listings surged 29.3% year over year in March 2026, while closed sales barely moved, rising from 0.2% a year ago. Now, the median sales price fell 1.5% year over year. More homes are sitting longer as buyers that once felt all over themselves to get into Seattle's vibrant markets are vanishing faster than an ice cube on hot pavement. Now, data from the Northwest Multiple Listing Service shows that compared to the same period last year, new listings for homes over $5 million and up are $5 million are up 40%, pending listings up 78%, and sales are up 66%, 66.7%. Now, that last number, the up 66.7%, sounds like good news until you understand what it actually means. Let me explain. The wealthy are racing for the exits before the door closes. The number of homes priced at $2 million or more jumped 65% the day after Democrats passed the bill compared to the same period last year. One day, 65 head-spinning percent. Active listings are now running 64% above the long-term March average, with analysts pointing directly to what one described as an exodus of sorts playing out across Seattle and Spokane as the primary driver behind the inventory flood. So what, say many, right? And I get it, I understand that. But here's the point I want to drive home today. The really scary stuff hasn't even happened yet. Company owners, and I know a lot of them, are taking their companies with them. Employees, families, fixtures, equipment, the whole enchilada. And remember, the tax that we're talking about hasn't even taken effect yet. All right, bottom line today, kind of on this theme. The world is reorganizing itself around different themes and in ways that don't respect Wall Street's old categories. So, point being, it makes sense to reorganize your thinking, and I submit your investing too. Now, and as always, let's make it a great day. You got this, and I'll see you tomorrow. Cheers.